Most of the stock picking videos you'll see on YouTube ask you to have faith. Buy this stock because the analyst likes it. Buy this one because the hot AI trend. Buy this one because the host has a feeling, right? Real catalysts are often hazy. The data backing the stock is usually minimal. And far too often the big move never quite materializes the way you expected. The list I'm going to share with you today is quite different. We're talking about 5 stocks across 5 sectors, each one backed by the data, and each one already experiencing a catalyst in the past 1 to 2 months that should keep propelling shares higher. One of the companies expects profits from a best-selling product to grow by roughly 40%. Another recently announced a 59% earnings beat, followed by an exciting acquisition. I'll get to those stocks and more in this video. And all of them have real concrete catalysts that have recently flipped the script, and the stocks have already started percolating higher. I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com. Our quant team built the Zen ratings that analyzes 115 different factors across 4,600 stocks every single day. Then we apply an intuitive letter grade of A through F to help you easily pinpoint the best stocks. Each name on today's list earns an elite A rating in our system that puts them in the top 5% of all stocks we analyze. By the way, if you want the algorithm to keep showing you more data-driven analysis like this, then hit the like button now. It tells me to make more videos like this in the future. And remember, I'm giving you ideas and data here, but any investment decisions you make are yours and yours alone. So be sure to do your own due diligence before executing any trades. Okay, let's dig in with stock number 1. We're talking about Mueller Industries with a symbol of MLI. The first name on the list missed earnings in Q3 of last year. Then it missed earnings again in the next quarter. The market penciled in a third miss for Q1 of 2026. Surprise! It delivered a 44% earnings beat instead. This was a clear sign that a turnaround was at play. The company is relatively unknown, even though it has a $13 billion market cap. This is likely because they are doing boring stuff like copper tubes, brass rods, and metal fittings. Boring, yes, but these are the all-important components that go into HVAC systems, plumbing, and refrigeration. And today, they're increasingly going into data center cooling and electrical infrastructure. Oh, now do I have your attention? Q1 2026 was the best first quarter in company history. Revenue jumped 19%, which translated into earnings growth of 55% year over year. On top of that, they closed a $142 million acquisition of Bison Metals to expand copper tube capacity. And they pulled all that off while keeping nearly $1.4 billion in cash and next to nothing in debt still sitting on their balance sheet. Now, despite those 2 previously mentioned earnings misses, there is good news on the growth front. That's because they have increased earnings nearly 39% over the last 5 years. On top of that, the growth is efficient. Return on equity and return on assets both sit significantly above industry averages. And then when you put the Mueller through our quant model, it gets a Zen rating of A. Right now it ranks in the top 3% of all stocks we track for the overall fundamental strength. This includes an impressive top 4% showing for sentiment. This means the stock is showing very bullish signals from the smart money side of the market. Things like analyst upgrades, raising earnings estimates, institutional money flows, and insider buying. The financial grade is also stellar in the top 3%, reflecting that fortress balance sheet loaded cash. Momentum is also solid, the top 13% of all stocks, meaning is already on the move, so more of a case of buy high and sell higher. Now, risk-wise, it's important to note that most industrial companies are cyclical, often swayed by the overall economy, tariffs, commodity prices. Right now, that's a tailwind for the company, but we do need to be mindful if that switches to a headwind in the future. But consider the full picture. 5 years of impressive earnings growth topped off by a recent stellar beat. Then add on a fantastic balance sheet to weather just about any storm, and you have the strong setup for more upside ahead. Now, the next pick is a semiconductor name almost nobody's talking about. Yet buried in a recent earnings call was a key phrase that should make every AI investor pay close attention. I'm talking about stock number 2 in Kulicke Soffa with a symbol of KLIC. Most of the top semiconductor stocks are overcrowded names by now. We're talking about NVIDIA, Taiwan Semiconductor, and the like. However, Kulicke Soffa is the picks and shovels play that almost nobody is discussing. The company makes the equipment necessary to assemble semiconductors. They sell into every major chip manufacturer on the planet, including the one supplying the massive AI buildout. But here's a detail few noticed from the February earnings call. The CEO told analysts demand is improving, and I quote, at a faster and stronger pace than previously expected. Okay, that is management speak for things are going really, really good. Okay, this explains the general semiconductor sales jumping 27% sequentially and over 90% year over year. This also translated into a strong 33% earnings beat for the quarter. Management then guided the results for the rest of the year to be 15 to 20% higher than previously expected. What we are seeing is the kind of exciting earnings momentum that comes from a strong semiconductor cycle, this one being fueled by enormous AI demand. And the expectation is that there's plenty of growth to come. Right now, forecasted revenue growth runs at 39% a year, nearly triple the industry average. The fundamental profile here is quite strong as Kulicke ranks in the top 2% of the stocks in the Zen rating system. That leads to an elite A rating. Now, the standout component grade is sentiment in the top 1%, proving the smart money is lined up behind these shares. This likely explains the top 5% showing for momentum. Financials are not too shabby either in the top 20% of all stocks, leading to a strong B grade in that category. There are a couple of risks to consider. One is that is a fairly high beta stock at 1.6, meaning it is much more volatile than the average stock, which is quite common for semiconductor shares. Also, if the AI capex cycle slows, then semiconductors will most certainly take a hit, as would Kulicke Soffa. But overall, it is very clear that this stock is experiencing tremendous earnings momentum thanks to soaring AI demand. The smart money is already on board. Perhaps you should be too. Quick pause before we move on. Go and hit that subscribe button right now if you're getting value out of this video. We publish new breakdowns every single week, and yes, subscribers get to see them first. The market is moving fast, so getting this info early can pay off. Now, the next stock is a company you most certainly enjoyed as a kid, and they just gave Wall Street a number nobody saw coming. I'm talking about stock number 3 in Hasbro, the leading toy maker with a symbol of HAS. Wall Street was only expecting tepid 3% revenue growth in the most recent report, yet Hasbro is guided to a range of 9 to 11% top-line improvement, with shares rightly jumping on this news. As you probably know, Hasbro is a toy and gaming company with more than a century of history. You know, they operate strong IPs like Monopoly, Magic the Gathering, Nerf, and Transformers. The trading card business is the real growth engine right now, thanks to the Wizards of the Coast division. It generated 90% of the company's operating profits last year. The catalyst behind that beat is Magic the Gathering. The latest set of cards was the fastest selling premiere in the history of the franchise. Now, profits for Q1 2026 are guided to come in 38 to 44% higher than last year, thanks to the strength of this franchise. Now, what you're seeing here is a potential comeback, and it's already starting to show up in the numbers. Now, Hasbro has the earnings track record to back up this bullish setup. This includes a 59% beat last quarter, which saw earnings per share increase 228% year over year. That is not a typo. I also want to draw your attention to the bullish Wall Street coverage of the stock, including 2 buy and 6 strong buy recommendations. Analysts aren't fortune tellers, but there's a lot of smart people suggesting the stock could grow from here. That group of bullish supporters includes top-rated analysts from Morgan Stanley, Citigroup, JP Morgan, and Goldman Sachs, telling you all the same thing. Our Zen ratings model is also quite bullish on Hasbro, with an A rating in the top 2% of all stocks. Even more impressive is that 4 of the component grades are also in prestigious A territory, including top 4% for growth, top 4% showing for sentiment, top 2% for financial strength, and top 1% for AI timeliness signal. As for the AI signal, it is based on our neural networks model looking at 20 years of market data to find often subtle patterns that lead to share price outperformance. Now, I want to be clear on the risk with this setup. As I mentioned, the trading card business drives 90% of the operating profits, so one soft release and the narrative changes fast. The recovery is also still early, as this is the first quarter of acceleration after 2 years of declining revenue. But when you have a consensus Wall Street strong buy, a recent 59% earnings beat in hand, and such strong grades from the Zen ratings model, then it's worth paying serious attention. Now, the next name is a small cap with one of the most violent earnings reactions of the year, in a good way. That brings us to stock number 4 in Alto Ingredients with a symbol of ALTO. Analysts forecasted that Alto would lose 2 cents per share last quarter. Then they delivered a 28% gain instead. That's a game changer. Let's take this story from the top. Alto produces ethanol and specialty alcohols, plus essential ingredients for food and industrial applications. They have 3 operating segments with a real focus on renewable fuels and the carbon credit economy. This is a small company with just $411 million market cap, plus shares are in the $5 range, meaning it's not on a lot of investor watch lists. The recent catalyst was the impressive earnings beat from the March 4th earnings print. The prime catalyst is Alto is actively monetizing 4FZ renewable fuel tax credits. That's a federal incentive program that pays producers for low emission fuel output. The stock has gone from 80 cents at the 52-week low to about the $5 range today, but there are signals that upward trajectory could continue to roll higher. This is primarily about the forecast for 47% earnings growth in the year ahead. That sounds great, but even better is their recent success in blowing away expectations. Few things boost shares faster than the kind of explosive earnings momentum that we see at play with this stock. That story shows up in our ratings as well. Alto has a Zen rating of A, ranked in the top 1% of every stock we cover. The standout grade here is sentiment in the top 1% of all stocks. This means the smart money is already on board. Not far behind is the top 4% showing for momentum. Rounding out their top fundamental scores is the top 20% showing for both growth and safety. That safety grade is kind of a surprise bonus here. It's rare for a small cap growing at this kind of pace. This is the most aggressive and speculative pick on today's list. So if you think it has a place in your portfolio, then do size your position knowing it carries a bit more risk. And by the way, before I get to the closing pick, a quick note. This is exactly the kind of analysis I walk through live every Monday at 7 p.m. Eastern Time. Not just what I'm buying, but how I'm finding it so you can do the same. I also share my hand-picked stock of the week, blending the power found in the Zen Ratings model along with my greater than 40 years of investing experience. All this and more is part of our live training session this coming Monday at 7 p.m. Eastern Time. It's totally free. Just sign up at wallstreet.com/live. You'll also find a link in the description or just scan the QR code you see on your screen. The fifth and final stock is the most highly rated name on the list today. Plus, not one, not two, but three catalysts dropped at the same time, which is certainly worthy of our attention. Let's dig into stock number 5 in Amneal Pharmaceuticals with a symbol MRX. Amneal is a specialty pharmaceutical company, market cap around $4 billion. They make affordable generics, biosimilars, complex injectables, and a small but rapidly growing branded specialty portfolio. This is the highest rated stock on the list today because Amneal scores in the top 1% of the Zen Ratings model. No doubt, the three recent catalysts have something to do with this top-notch grade. And we're talking about recent 59% earnings beat, accretive $1.1 billion acquisition, raising guidance for the future. Those three catalysts, that's not bad for one day's work. Three exciting catalysts stacked into a single announcement. And as for the Kulicke acquisition, that's the $1.1 billion acquisition. This deal builds out a vertically integrated biosimilars platform, which is one of the highest margin growth categories in pharma. The fundamentals back up the catalyst story. Forecasted earnings growth runs at 129% a year. Yeah, 7 times higher than the industry average. And bear in mind, we're dealing with a proven pattern of outperformance. Amneal has beaten earnings estimates for 5 quarters in a row. Another factor worth noting is that the PEG ratio is just 0.47. Anything under 1 points to impressive value for the growth expected in the future. The Wall Street analyst picture is just as strong. Amneal's consensus strong buy with an average target price that implies 27% upside in the year ahead. However, the street high forecast is calling for more than 50% gains in that time frame. The Zen rating system confirms what the fundamentals and the analysts are saying. AMRX grades A overall, sitting in the top 1% of all stocks we cover. When you look under the hood, we have 4 strong component grades. Top 16% for that AI timeliness signal, top 12% for value, top 3% for sentiment, and top 2% for growth. And that is focused on the consistency of growth, which is usually the hallmark of a company more likely to beat expectations in the future. Now, I'm going to level with you about the risks. The company carries meaningful debt, plus the biosimilar space is competitive, and the recent Kulicke acquisition, that integration carries real execution risk over the next 12 months. But I think the pattern outperformance and the fundamental strength have enough steam to win out against those drawbacks. Wall Street experts and the Zen ratings fully comprehend the benefit of the 3 prime catalysts for Amneal. Yet with the low PEG ratio, it feels like the rest of the market is still mispricing shares. That often spells opportunity for those wise enough to act now. Now I want to hear from you guys. Which of these 5 stocks catches your eye? Or perhaps there are some you disagree with. Please share all your thoughts in the comments section below. Now, if you enjoyed this presentation, I suggest checking the video that's popping up on your screen right now. That's because I cover 4 AI stocks that could see significant upside in the near future. Don't miss it. Thanks for watching, and we'll see you next time.